First of all, just big picture, wanted to address the kind of gist of what Kathy was saying in that soundbite. And I totally get that point, but I guess the problem with it is back in February when things were 40% higher, there wasn't a different gist coming from Kathy to say, yes, things are richly valued. So it's almost as if you guys always come out and say, look, we're picking the innovators and the disruptors, and price never matters at all.
That's absolutely not the case. I think you have to go back and look at the tape, probably your own tape. Back in February, Kathy was saying that, keep some powder dry, and now we're saying innovation is on sale. I think you can, when you're in the equity markets, this is an asset class where you have to focus on the medium-term time horizon. If you're putting money into equities, it should not be money that you're trying to extract out in 3 or 6 months. And so that's why we do our valuation work over 5 years, and why we stay focused on process, stay focused on valuing the innovations that we're investing in, and today see super meaningful appreciation opportunities in the intangible assets that we're purchasing on behalf of our clients. So I think that if you believe that kind of like this innovation stuff is a fiction, if you believe that AI training costs declining at twice Moore's law is not something that's going to meaningfully impact the world over the next 5 years, then absolutely you could believe that the assets are mispriced on the basis of that expectation. But our belief is this is a unique time in technological economic history, and that focusing directly on innovation and exposing yourself meaningfully to innovation is important to realize the appreciation events that are to come in the innovation space.
Totally get that, Brett, and particularly the point about the scale of disruption that could come and having a 5-year or long-term time horizon. Given that time horizon, does that allow you to pretty much ignore the changing kind of market multiple that gets applied to your type of stock, particularly if the Fed starts raising rates and if we continue to see more dislocation in your types of stocks? Can you just ignore that because it'll only affect things on a 6-month or 12-month or 24-month time horizon at most?
Well, we do all of our underwriting on a 5-year basis, and on the 5th year, we pretend as if we're forced sellers to people who aren't techno-optimists, to people that just pay for cash flow. And so we actually massively compress the multiple in the underwriting that we do. And so over the time horizon that we invest, we assume that the assets that we're investing in are going to collapse to whatever that market multiple is. And on that basis, we have expectations for multiples of appreciation in the companies that we invest in across our entire portfolio. Now, we could be wrong about the fundamentals. We could be wrong about the fact that the technologies are economically meaningful in a profound way. But if we happen to be right with our underwriting, we think the portfolio would appreciate 5 times over 5 years.